which is the main measure of consumer inflation that directly affects people's wallets. The market now believes the Federal Reserve will be forced to be more aggressive in cutting interest rates. Liquidity zone we had with the S&P 500 in the down part is... Hello, my name is Isaac Martinez, a trader and market analyst here at xChief, and welcome to our weekly outlook. Following last week's shocking jobs report, the market is now pricing in a much more aggressive Federal Reserve. But will they deliver? The answer could lie in this week's critical CPI inflation data and the ECB's rate decision, which are set to bring major volatility. We'll break down exactly what you need to watch. We will start as always with the economic calendar, and don't forget the hours you are going to see are based on the New York time zone. The week starts off very quiet with no major events scheduled for Monday or Tuesday, so we'll jump straight to Wednesday. At 2:30 p.m. we get the Producer Price Index or PPI from the United States. Think of this as an inflation indicator from the perspective of businesses and manufacturers. It measures the price changes for the goods they produce, and it can often be an early sign of what we, as consumers, will end up paying down the line. Thursday is the most packed day of the week with major events for both the euro and the US dollar. At 2:15 p.m. all eyes will be on the European Central Bank as they announce their main refinancing rate, which is their key interest rate. At the same time, they'll release their monetary policy statement, which explains the reasoning behind their decision. Then just a few minutes later, at 2:30 p.m., we have a batch of critical data from the US. This includes the Consumer Price Index or CPI, which is the main measure of consumer inflation that directly affects people's wallets. We also get the weekly unemployment claims at that same time, giving us a fresh look at the health of the US job market. Following all that, at 2:45 p.m., we'll be listening closely to the ECB press conference. This is where the head of the bank answers questions and traders will analyze every word for clues about future economic policy, which can cause significant volatility in the euro. Finally, we close out the week on Friday at 4 p.m. with two reports from the University of Michigan. The first is consumer sentiment, which is a survey that measures how optimistic people are about the economy and their own finances. And the second is the inflation expectations, which tell us what consumers think will happen with prices in the future. Both are important for gauging the mood of the consumer, which is a huge driver of the US economy. Now let's continue with the most important fundamentals of the past week. Following up on the jobs report, this new information confirms the labor market's weakness, and most importantly, it shows us how the markets reacted and what major analysts are thinking. The immediate reaction to the data was very clear and logical. The market now believes the Federal Reserve will be forced to be more aggressive in cutting interest rates. We saw stock futures like the S&P 500 move slightly higher, and bad economic news is often interpreted as good news for stocks because it anticipates more stimulus. In the bond market, treasury yields fell sharply, a classic sign that investors are pricing in rate cuts. And as expected, the dollar index weakened considerably, as a currency tends to lose value when its interest rates are expected to fall. The consensus among analysts is clear. The possibility of a more aggressive rate cut of 50 basis points instead of 25 is now back on the table. Several economists point out that the weakness is so notable, especially with the revisions to previous months, that job creation is practically zero. They point to uncertainty over trade tariffs as the main reason companies have frozen their hiring. However, not everyone believes the Fed should act without caution. Some more conservative analysts warn that while a rate cut this month is almost certain, the Fed must trade carefully, as too much stimulus could awaken inflation down the road. Now let's continue with the technical analysis, and as always we will start with the US dollar index. The first thing we need to understand is that right now, after the last reports we had, especially from the non-farm payrolls, we had a very strong retracement with the price trying to break the support that was located at 97.556. If this movement continues, then we can put targets for the 97 98.109, and the last target we can consider for this week, we could be expecting the 96.377. On the other hand, if we are trying to be bullish with the DXY, with the US dollar index, depending if we have any kind of fundamentals that can boost this new movement, we can consider the 98.421 and the 98.693. After this, if we continue with an upward movement, we can also consider 99.569 and 100.256. For the S&P 500, after the report of the non-farm payrolls, we are seeing here a clear upward reaction, leaving a little gap, but right now we are seeing a retracement, so maybe it is possible to have now a downward movement, trying to catch all the liquidity and trying to manipulate all the longs that were opened recently. Considering this information, we can establish bearish targets. The first one, 6,343, the second one, 6,261, considering this gap and the 50% of it, and finally the last support we can see here, and also the most important liquidity zone we had with the S&P 500 in the down part, is 6,212. If you are still bullish with the S&P 500, don't forget that the next target, considering Fibonacci extension, is located at 6,803. Let's go now with the euro. We're seeing basically the same movement we have with the DXY, but in the opposite direction. So right now the euro is trying to break out this resistance and trying to stay there. After this breakout, we're expecting to have a throwback to the same place, trying to make this resistance a support, and after this we can see new upward objectives. The first one is located at 1.17889 and the last one is here, 1.18299. On the other hand, if we start seeing a strong downward movement, we can consider all the liquidity zones we have established in the last week. 1.16083, the first one. The second one is the support we were considering last week, 1.15830. And finally, we have here another support, another liquidity zone located at 1.15276. With Bitcoin, we had a strong upward movement when the NFP's report was released. Here we tried to break this resistance at $113,480, but Bitcoin wasn't able to do it. So after this, we need to consider that the price can try to get liquidity from the down parts. The first zone is located at $109,338. The second one is $108,400, and the last one, $107,448. The most important liquidity zone obviously is this one, and after this zone we can consider that the price could have a reaction to start to dominate zones. If the price doesn't break the resistance we were talking here at $113,000, it will be impossible to establish new bullish targets. But if that happens, we will be considering $117,208 and $119,677. And that concludes our analysis for the week ahead. To position yourself for the events we've discussed, I invite you to register for an account with xChief, where you will find the professional tools and conditions necessary to navigate these markets. If you have found this analysis valuable, please support our channel by giving this video a like and subscribing for more weekly market insights. Thank you for your time, and I wish you a successful trading week.